If your money is sitting in a bank account right now, you're quietly losing purchasing power. Not because you're careless, not because you're bad with money, but because inflation never sleeps. Every year prices rise, and if your money isn't growing faster than inflation, it's shrinking in real terms. In 2026, doing nothing with your money is still a decision, and it's usually the most expensive one. So in this video, I'm going to show you how absolute beginners can grow their money faster than inflation using simple, proven investing principles. No hype, no secret strategy, no gambling on trends, just fundamentals that have worked for decades. First, we need to redefine what fast actually means. A lot of people hear grow your money fast and imagine doubling their investment in a year or finding the next hot stock before everyone else. That mindset leads to speculation, not investing. Real investing is about steady growth that compounds over time. If inflation averages around 3 to 4% and your investments grow at 7 to 10% annually over the long term, you're not just keeping up, you're pulling ahead. That gap between inflation and your return is where real wealth starts forming. Fast doesn't mean overnight, it means efficiently. It means not wasting years. Before you invest a single dollar, you need a stable base. This is where most beginners skip steps and regret it later. Step 1. Build an emergency fund. Ideally 3 months of essential expenses. Investing works best when you can leave the money untouched. Markets move up and down. Some years are great, some are negative. If you're forced to withdraw money during a downturn because you didn't have savings, you lock in losses. An emergency fund protects your investments from becoming your backup plan. Step 2. Eliminate high-interest debt. If you're paying 20% interest on credit cards, investing for an average 8% return doesn't make sense mathematically. Paying off that debt gives you a guaranteed return equal to the interest rate you're avoiding. Once those two foundations are solid, you're ready to grow. Now let's talk about what beginners should actually invest in. One of the biggest mistakes new investors make is thinking they need to pick individual stocks. They believe they have to identify the next big winner. The reality is most professionals struggle to consistently outperform the broader market. Instead of trying to predict which single company will dominate, beginners are often better off owning a broad slice of the entire market through index funds. An index fund tracks a large group of companies rather than relying on one. For example, the S&P 500 index represents 500 of the largest companies in the United States. When you invest in a broad index fund that tracks a major market index, you're essentially investing in the overall growth of the economy. You're diversified across industries. You reduce the risk of one company collapsing and hurting your portfolio significantly. Historically, the U.S. stock market has delivered average annual returns in the high single digits over long periods, even after accounting for inflation. That doesn't mean every year is positive. Some years are volatile, but over decades, growth has been consistent enough to outpace inflation significantly. Here's where the real acceleration happens: compounding. Compounding is the reason investing works. When your investment earns a return, that return stays invested. Then next year, you earn returns not just on your original money, but also on last year's gains. Over time, this snowball effect becomes powerful. Let's say you invest $300 per month. That's $10 a day. At an average annual return of 8%, after 10 years, you could have around $55,000. After 20 years, roughly $175,000. After 30 years, over $400,000. You didn't pick winning stocks. You didn't trade daily. You didn't time the market perfectly. You were consistent. The key variable wasn't genius, and it was time. This is why starting early matters more than starting big. Many people delay investing because they feel they don't have enough money. But waiting 5 years to begin can cost you far more in lost compounding than starting small today. The earlier your money begins working, the longer compounding has to multiply it. Another critical principle for beginners in 2026 is automation. Investing is less about intelligence and more about behavior. Set up automatic monthly contributions. Treat investing like a non-negotiable expense. When it's automated, you remove emotion. You don't hesitate when markets are down. You don't get overly confident when markets are soaring. You stay consistent. Trying to time the market, but waiting for the perfect entry point, often leads to missed opportunities. No one consistently predicts short-term market movements, but long-term economic growth has historically trended upward. Automation ensures you participate in that growth without needing to forecast headlines. Now let's cover mistakes that slow down beginners. First, chasing trends. When something is all over social media and everyone claims it's the future, prices often already reflect that excitement. Investing based on hype increases risk. Second, panic selling during downturns. Market corrections are normal. They've happened repeatedly throughout history. Selling during fear turns temporary declines into permanent losses. Third, expecting immediate results. Investing is not entertainment. It's not supposed to be thrilling, it's supposed to be boring and effective. So what does fast realistically look like? It looks like steadily increasing your net worth year after year. It looks like outpacing inflation. It looks like building ownership in productive companies. It looks like gaining financial stability and options over time. You probably won't double your money this year, but you can absolutely build momentum that changes your financial trajectory over the next decade. In 2026, the biggest risk for beginners isn't investing responsibly. It's staying stagnant while inflation erodes your savings. Start with a solid foundation. Invest broadly. Be consistent. Let compounding work. Growing your money fast isn't about chasing speed, but it's about eliminating wasted time. The sooner your money starts working for you, the sooner you create flexibility, security, and long-term leverage in your life. If you found this helpful, the next step is learning how to structure your first simple investment plan, step by step. That's where clarity turns into action. If you found this video helpful, subscribe to my channel to get more updates. Thanks for watching.